The year is 2008. Adjustable rate mortgages have just helped detonate the global financial system. Millions of homeowners watch their payments spike to levels they can't afford. The word ARM becomes synonymous with financial ruin for an entire generation. Here is what that history taught the mortgage industry, and here is what it didn't teach, which is that a modern adjustable rate mortgage is a fundamentally different product than the teaser rate instruments that caused the crisis. And in specific situations, for specific buyers with specific plans, an ARM is the smarter financial choice. This video isn't about convincing you to get an ARM. It's about making sure you're not avoiding one out of a fear that's based on a product that no longer exists in the same form. An adjustable rate mortgage has an interest rate that changes periodically based on a benchmark index, typically the Secured Overnight Financing Rate, or SOFR, which replaced LIBOR as the primary ARM benchmark in recent years. Modern ARMs are almost always hybrid products, meaning they have an initial fixed rate period followed by periodic adjustments. The most common structures are the 5-1 ARM, the 7-1 ARM, and the 10-1 ARM. A 5-1 ARM has a fixed rate for the first 5 years. After that, the rate adjusts once a year based on the current index plus a margin, a set percentage your lender adds on top. A 7-1 ARM fixes the rate for 7 years. A 10-1 ARM fixes it for 10. Here is what is different about modern ARMs compared to 2008-era products. Modern ARMs have rate caps built into the loan structure. They're contractually required. A typical cap structure looks like this. A 255 cap means the rate can't increase more than 2% at the first adjustment, no more than 5% over the life of the loan, and no more than 5% from the initial rate ever. Your worst-case scenario is calculable before you sign. The pre-negative 2008 products that caused the crisis often had no meaningful caps. Teaser rates that bore no relation to the fully indexed rate, and negative amortization features, meaning your balance could actually grow even while you were making payments. These features are now either banned or so heavily regulated that they functionally don't exist in mainstream lending. An ARM isn't the right product for every buyer. It's the right product for specific buyers in specific situations. Here are the ones where the math works. Situation 1. You know you're not staying long. If you have a realistic expectation of selling or refinancing within 5 to 7 years, because of a career that moves you, a family situation that will change, a market you're buying into temporarily, a 5-1 or 7-1 ARM often makes sense. If you capture the lower initial rate, you sell or refinance before the adjustment period begins, and you never experience a rate change. The initial rate on a 5-1 ARM is typically half a point to a full point lower than the 30-year fixed rate. On a $300,000 loan that's roughly $80 to $160 a month, over 5 years, that's $4,800 to $9,600 in savings, for a buyer who's not going to be in the home past the fixed period anyway. Situation 2. You expect significant income growth. A first-time buyer in their late 20s with a rising income trajectory, medicine, law, engineering, skilled trades, may have a payment that feels tight today, but will be comfortable in 3 to 5 years. The ARM's lower initial payment eases that early pressure. By the time the rate adjusts, income has grown enough that even a higher payment is manageable. Situation 3. Rates are historically high and expected to fall. In an environment where rates are elevated and market consensus points toward cuts in the coming years, an ARM lets you capture rate decreases automatically, without the cost and paperwork of a refinance. Situation 4. The spread between ARM and fixed rates is significant. When the difference between a 30-year fixed rate and a 5-1 ARM rate is more than a full percentage point, the case for the ARM, for buyers who meet the other criteria, becomes mathematically compelling. The situations above are specific. The situations where an ARM creates real risk are equally specific and worth taking seriously. If you're buying at the top of your budget, if you're qualifying for the home based on the ARM's initial lower payment, and you wouldn't qualify at the fully indexed rate, you're taking on real risk, If rates adjust upward at the end of your fixed period and your income hasn't grown commensurately, your payment becomes unmanageable. This is the 2008 pattern. It didn't destroy people because ARMs existed. It destroyed people because they were qualifying on teaser rates for homes they couldn't afford at the real rate. You plan to stay in the home long term. If you're buying your forever home or close to it, a fixed rate provides certainty over a timeline where rates can move dramatically in either direction. The initial savings of an ARM don't justify the uncertainty over a 25 to 30-year horizon. Your income is variable or uncertain. Freelancers, commission salespeople, small business owners, anyone whose income fluctuates significantly are exposed to the combination of payment uncertainty and income uncertainty simultaneously. A fixed rate removes at least one variable from that equation. If you have low reserves, if your emergency fund is thin and your monthly budget is tight, a payment that could increase by 2% at the first adjustment is a meaningful financial risk. Let me put concrete numbers on this so you can run your own version. $300,000 loan, 30-year fixed at 6.8%, monthly payment $1,161. Same loan as a 5/1 ARM at 6.1%. Monthly payment $1,819. Monthly savings $142 over 5 years, $8,520 saved during the fixed period. At year 5, the rate adjusts. Maximum first adjustment is 2%, taking the rate to 8.1%. New payment $2,222. That is $261 more a month than the original ARM payment, but only $161 more a month than the 30-year fixed you would have had anyway. If you sell or refinance before year 5, you keep the full $8,500 in savings. If you stay and rates adjust to the maximum, you're paying $161 more a month than you would have on a fixed rate. The question isn't whether ARMs are safe or dangerous in the abstract. The question is, what's your realistic timeline, and what does your specific cap structure mean for your payment in the worst case? Run that math before you decide. The 2008 financial crisis left a scar on the word adjustable rate mortgage that is still visible in how first-time buyers react when it comes up. That reaction is understandable. It's also based on a product that has been significantly reformed. The modern ARM is a different instrument, with mandatory caps, regulated index rates, and disclosure requirements that make the worst-case scenario calculable before you sign. It's not the right product for every buyer. If you're buying long-term at the top of your budget, with thin reserves and an income variable situation, the fixed rate is almost certainly the right call. But if you have a realistic shorter-term horizon, a rising income trajectory, or you're in a high-rate environment that's expected to ease, the ARM is worth running the numbers on before you dismiss it. Do not let a 15-year-old crisis make a decision that should be made with current math and your specific situation. Fixed or adjustable, you now have what you actually needed to make that call. Your specific situation, not someone else's rule. Like and subscribe for 3 new videos every week built around that same principle.